What's going on, everybody? What's up? What's up? Shout out to y'all. How's everybody doing on this Sunday evening, Sunday night, Sunday morning, wherever you at in the world? Shout out to y'all. Shout out to y'all. Make sure y'all hit that like button, subscribe if you're brand new. What's up, Law Docs? What's up, Daryl? What's up, Jay Manson? How's everybody doing? It is Sunday, March the 30th, 2025. We have one more day to end the month, and we're going to end the first quarter of 2025. So it's kind of been a drag. So we're finally coming to the monthly close and that quarterly close. So I've been anticipating that so we can get this second quarter of the year started to see how these markets want to operate and trade. So I've been anticipating that. What's up, Jay Manson? You say you're straight. Shout out to you. I got 14 people in the live stream. Make sure y'all hit that like button, subscribe to the channel. Give me a quick roll call. Y'all shout out where you're from, your city, state, region, country, wherever you are in the world. Give me a roll call. I want to see where everybody is at. It is currently 8:30 Eastern Standard Time. It is currently the Asia session on a Sunday. Shout out to Austin, Texas. Good evening, Lawrence. What's up, Donna? What's up, Scotty? You said you wanted to ask me, can you see a reverse carry trade unwinding in the charts? You see when Japan goes down. Let me reread that question. You said, I wanted to ask, can you see the reverse carry trade? I don't know what you're talking about. Unwinding in the charts. Reverse carry trade. I'm not familiar with that. What's up, Scott? What's up, Donna? We got Canada in the building. We got Earth. We got human beings in the building. Definitely appreciate y'all joining on this Sunday evening. Appreciate y'all time this evening. What's in the news today? I'm always going to ask y'all, what have y'all been seeing? Because I can't keep track of everything. So what's some headlines that y'all been keeping up with? Shout out to BR, Louisiana. Shout out to you. What's up, Lenny? Shout out to Chicago in the building. Talking about the Japanese yen. I'm not worried about it. I'm not worried about it at all. Not worried about it. I really don't track the yen, the markets that I follow, because again, we think like smart money. You can have your capital in any one of these markets. So I'm not really concerned. There's always opportunity. Even when y'all think it's a crash, there's opportunities when the market is going lower. What's up, Omar? Shout out to you. Shout out to you. Appreciate y'all joining. Make sure y'all hit that like button. Subscribe if you're brand new. If you want to learn technical analysis, I got my Patreon available. Make sure y'all come over here and sign up if you want to learn. For the people that are already signed up for it, go ahead and give your testimony in the live chat so other people can see what they're getting involved with. But the link is in the description below. So go ahead and come over here, sign up if you want to learn technical analysis from a basic level. What's up, Ed? Shout out to you. Shout out to the Bay Area. Shout out to the Bay Area. Shout out to California. Make sure y'all shout out where y'all from. We are a global community, and that's a beautiful thing. We live in a time where we can communicate with people all around the world real time. So there was a time we couldn't do that as humans, but now we're doing it. Shout out to California in the building. LA, Los Angeles, the city of angels. Shout out to LA. But what's up with y'all though, man? What's in the news today? What have y'all seen? Anything in the news over the weekend or what is coming up this week as far as like let's say legislation in anything in Congress? That's what I'm trying to say. Anything in Congress, anything in legislation. What's going on with that on that side of the spectrum? What are y'all experts in? I want to know what y'all are experts in, because this is a network. So I'm an expert in the TA. So a lot of y'all might want to learn from me, but I'm also willing to learn from other people. So what are y'all experts in? What do y'all mainly keep up when it comes to investing or trading? What do y'all keep up with? Because I'm just a specialist in price action. Some of y'all are great at research. Some of y'all are great at doing deep research. So I want to get connected with people who really know how to research. I'm also thinking about adding for the people that join the Discord, the Patreon. I'm thinking about having it to where when I do my live streams, I can bring some of y'all on the panel, make it like a panel and get like group discussion, because again, I don't know it all. I'm just an average person. I'm just skilled in what I know, but some of y'all might want to bring a conversation to the table. Some of y'all do have other things to bring to the table, different perspectives, different opinions. So I would like to do a panel style on my live stream and allow some of y'all to speak for the ones that join the Patreon. But definitely hit that like button, y'all. Appreciate it. One thing I want to start off with is not really news, but it's a video that I find very interesting. Pretty much the mechanics of money. Are y'all familiar with the mechanics of money? And if you are, let me know in the comments. Are you familiar with the mechanics of money and how the financial system works and operates currently, and how we are transitioning away from the current mechanics of the system? Jay Manson, you're not familiar, so y'all not familiar with it. I'm sure you're familiar with it, but we can dive a little deeper into it. So let me come to this video. And this is dealing with money creation and fractional reserve banking. So are you familiar with fractional reserve banking in the current system? And how this, to me, is the slavery 2.0, like outside of physical slavery, fractional reserve banking system, that is slavery. It is a mental slavery. And it's about classism. It brings about classism and, classism alone, people treat other people differently. If you have, or if you have not, the have-nots get treated differently. And it's all behind this system of money creation and fractional reserve banking. So let's go ahead and get into this video. And I want to get y'all perspective on it. You can leave a comment in the chat as I play it.
A number of years ago, the Central Bank of the United States, the Federal Reserve, produced a document entitled Modern Money Mechanics. This publication detailed the institutionalized practice of money creation as utilized by the Federal Reserve and the web of global commercial banks it supports. On the opening page, the document states its objective. The purpose of this booklet is to describe the basic process of money creation in a fractional reserve banking system. It then proceeds to describe this fractional reserve process through various banking terminology, a translation of which goes something like this.
So y'all definitely pay attention to this part right here. This is how the other day when I did my live stream, when I was saying, who remembers what I said? When you want to follow the money, where do you start? I asked y'all that. So do y'all remember, for the ones that joined the live stream, do y'all remember when I asked, when you want to follow the money, where does the money start? Y'all leave me a comment. Let me know in the chat. What do y'all remember? Or if you don't know, guess. Take a wild guess. There you go, Lenny. The central banks. There you go, Jay Manson, the central bank. So this video is going to explain how they create money in that process. And y'all might have to think deeply about it. If this is new to you, then you might have to rewatch the live stream, or really think about the process of money creation and how this entire system is built on debt. So let's go ahead and continue the video.
The United States government decides it needs some money, so it calls up the Federal Reserve and requests, say, $10 billion. The Fed replies, saying, sure, we'll buy $10 billion in government bonds from you. So the government takes some pieces of paper, paints some official-looking designs on them, and calls them treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. In turn, the people at the Fed draw up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the Fed.
So do y'all understand that part right there? We're going to walk through this, and then after we do this, I'm going to come to the charts. But y'all understand that part right there? The United States government pretty much is in debt. They don't have no money. They're bankrupt, but they need to borrow $10 billion. So what they do is they print out paper or digits on a screen, type it up, print it up, whatever, and they send it over to the feds. And they they're considered treasury bonds, or they're called treasury bonds, and the value of $10 billion. So the Fed decides, okay, we'll buy them. So that transaction alone makes the United States in debt. Let me go right quick. I'm gonna come back to this. I'll do that after that. We're gonna look at the debt clock. We're gonna look at the debt clock because off the top of your head, or those that got cell phones, what is the current United States debt right now? What is the debt right now in the United States? Or do I need to go look it up? Would y'all rather me look it up? Let me see right quick. U.S. debt clock. 38 trillion. Let's go see. Okay, watch this. 38 trillion. So let's go look at it right quick. This is the United States debt clock. And that's the current national debt for the United States. So what I just showed y'all in that video, this is the United States taking treasury bonds. And look, it's like nonstop. It's almost automated. It is automated. So the old way of doing it was printing paper, printing treasury notes and sending it off in suitcases and Brinks trucks. But now it's all digitized and computers on the screen. So that's why this shit is just running to the abyss. It's never coming back. We're never paying this off. So that entire process of us needing money, sending it to the Federal Reserve, and in return, they're inflating, or they're giving back cash into the system. They're printing money out of thin air. So I'm gonna say roughly whatever. You say 37 trillion. It's getting close to 37 trillion. So that's the United States debt right now currently, and you can see it continuing to tick. I don't understand how they keep up with it right here, but we're just gonna use this as a guide to what the debt is real time. Look at the debt per citizen right here. Debt per citizen. So each one of us American citizens, we roughly owe $107,000 into pretty much $107,000 in debt. Debt per taxpayer. So for us tax-paying citizens, $323,000. And then U.S. federal spending official, they spending around 7 trillion, etc. And then they added this Doge clock. So what's the purpose of Doge? They're pretty much trying to find all the money. So far, allegedly, because I don't know how true this is, they have found 261 billion out of 36 trillion. Well, they got a lot of work to do, because I don't know how they're gonna make up for this. So this is what I'm pretty much showing you in this video, this process. So every time the United States government and global government, so for example, I could come up and look at the world debt. Let's go look at the world debt, which is probably more crazier than this. Let's see if I can scroll to the bottom. Well, it doesn't totally all up on this. I had to get out my calculator, which it might break. But somebody, if y'all know off the top of your head, what's the world debt that they roughly got calculated? And as you can see, America, United States, blowing the entire world out the water, 36 trillion. China, 15 trillion. Germany, 3 trillion. Japan, 12 trillion. India 3 trillion, UK 4 trillion, France almost 4 trillion, Italy almost 4 trillion, Brazil 2 trillion, Canada 2 trillion, Argentina 575 billion, and so on and so forth. You know, that's the world debt, and the entire world is running off of this debt system based on just printing money out of thin air. So let's go ahead and come back to the video. Let's finish the video, get y'all perspective on it. Y'all can continue to comment. So hopefully y'all got that first part of the video, how the United States government, they're broke. So they issue treasury bonds in exchange for United States dollars from the Federal Reserve. That's the system. So let's continue.
The Fed then takes these notes and trades them for the bonds. Once this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits it into a bank account. And upon this deposit, the paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And there it is. $10 billion in new money has been created. Of course, this example is a generalization, for, in reality, this transaction would occur electronically, with no paper used at all. In fact, only 3% of the U.S. money supply exists in physical currency. The other 97% essentially exists in computers alone.
That's another key part. Did y'all know that? That only 3% of the debt that we claim is in physical cash, physical money. The rest of it, 97% of it, is all digital. And that's another reason why we're moving to this cashless society, because we're not there yet, but we're moving to that cashless society because it's already digits. Like when you go deposit a check into your bank account, they're pretty much taking your physical cash, dispersing it back into the economy or whatever they're doing with it, and just putting digits on the screen from your phone, your computer, in your bank account. That's all it is. It's 97% digital, all the money. So that's why we might as well just go to a cashless society and go to distributed ledger technology. So definitely keep up with that. Let's continue the video.
Now, government bonds are, by design, instruments of debt. And when the Fed purchases these bonds, with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt. This mind-numbing paradox of how money or value can be created out of debt or a liability will become more clear as we further this exercise. So, the exchange has been made, and now $10 billion sits in a commercial bank account. Here's where it gets really interesting. For as based on the fractional reserve practice, that $10 billion deposit instantly becomes part of the bank's reserves, just as all deposits do. And regarding reserve requirements, as stated in modern money mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. It then quantifies this by stating, under current regulations, the reserve requirement against most transaction accounts is 10%. This means that with a $10 billion deposit, 10% or $1 billion is held as the required reserve, while the other $9 billion is considered an excessive reserve and can be used as the basis for new loans. Now, it is logical to assume that this $9 billion is literally coming out of the existing $10 billion deposit. However, this is actually not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit.
And boom, that's the debt system right there. How they keep, so banks are allowed. So pretty much the Federal Reserve, they send out cash to the United States government. Then that cash is deposited into commercial banks. And then as soon as that deposit hits the commercial bank, banks are allowed to pretty much multiply the money out of thin air. And that's the fractional reserve aspect of the system. So anytime you take your paycheck or anytime you get a deposit into your bank account, whatever that amount is, let's say $5,000. You take a $5,000 check, you deposit it into your bank account. That bank is allowed to fractionalize it and multiply it. And all you are left with is digits on your screen, while on the back end, they're able to do whatever they're able to loan out your money and do whatever they want with the money. So that's the fractional reserve banking system. It's all corrupt. We know that, but I'm just saying, like, it's all corruption. Let's continue.
This is how the money supply is expanded. As stated in Modern Money Mechanics, of course they, the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes, loan contracts, in exchange for credits, money, to the borrower's transaction accounts. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements. Now, let's assume that somebody walks into this bank and borrows the newly available $9 billion. They will then most likely take that money and deposit it into their own bank account. The process then repeats, for that deposit becomes part of the bank's reserves. 10% is isolated, and in turn 90% of the $9 billion, or $8.1 billion, is now available as newly created money for more loans. And of course, that 8.1 can be loaned out and redeposited, creating an additional 7.2 billion to 6.5 billion to 5.9 billion, etc. This deposit money creation loan cycle can technically go on to infinity. The average mathematical result is that about $90 billion can be created on top of the original $10 billion. In other words,
and that's most likely why we see the debt clock going crazy like it is right now. You know what I'm saying? That's most likely why we see this debt clock, because they're able to just print it into infinity. And that's why it just keeps going up. So it's probably already calculated. So every time we borrow money, they can just print, they can just add on top of the infinity part where it's like nonstop. And again, there's no ceiling to the debt. Let's go back and continue the video.
For every deposit that ever occurs in the banking system, about 9 times that amount can be created out of thin air.
Money jitters. Ask the obliging Bank of America for a jar of soothing instant money, M-O-N-E-Y, in the form of a convenient personal loan.
So, now that we understand how money is created by this fractional reserve banking system, a logical yet elusive question might come to mind. What is actually giving this newly created money value? The answer? The money that already exists. The new money essentially steals value from the existing money supply. For the total pool of money is being increased irrespective to demand for goods and services. And as supply and demand finds equilibrium, prices rise, diminishing the purchasing power of each individual dollar. This is generally referred to as inflation, and inflation is essentially a hidden tax on the public.
What is the advice that you generally get? And that is, inflate the currency. They don't say debase the currency. They don't say devalue the currency. They don't say cheat the people who are saved. They say lower the interest rates. The real deception is when we distort the value of money. When we create money out of thin air, we have no savings, and yet there's so-called capital. So my question boils down to this: how in the world can we expect to solve the problems of inflation, that is, the increase in the supply of money, with more inflation?
Of course, it can't. The fractional reserve system of monetary expansion is inherently inflationary. For the act of expanding the money supply without there being a proportional expansion of goods and services in the economy will always debase a currency. In fact, a quick glance at the historical values of the US dollar versus the money supply reflects this point definitively, for the inverse relationship is obvious. $1 in 1913 required $21.60 in 2007 to match value. That is a 96% devaluation since the Federal Reserve came into existence. Now, if this reality of inherent and perpetual inflation seems absurd and economically self-defeating, hold that thought, for absurdity is an understatement in regard to how our financial system really operates. For in our financial system, money is debt, and debt is money.
So do y'all understand that part, that money is debt and debt is money? Y'all should. The cash, I'm talking about the cash aspect of it, like the fiat dollar, the United States dollar, or your respective country's currency. It is debt. It's like literally a debt note. It's literally a debt note. So think about that when you're, going to work, or it's all a game. We know this. And this is why we need to get these debt notes. And the game is to exchange them for assets. So we're working hard with this paper fiat, and everybody, it's not just the citizens, it's also corporations. It's all one big hustle. So everybody is in the rat race, even large corporations. They're all trying to chase fiat paper currency. We're all trying to chase fiat paper currency and outdo one another. That's why it's classism, because one group of people might have more debt as far as fiat currency than the next. But the smart people, the wealthy, they exchange that debt for assets, physical assets, real estate, land, artwork, stocks, different assets that you can invest in, businesses. Businesses are assets. So just make sure y'all understand that the paper that you're working for, that's why you got to be mindful of what you spend your money on, because you literally labored for that cash. You labored for it, and in exchange, they pay you in debt. So think about that. Your paycheck is debt. When they pay you a paycheck, that is debt. And then we deposit it into a bank account, and they just continue to inflate the debt. So this is all one big game. So hopefully people start making wiser decisions when it comes to their money.
Here is a chart of the U.S. money supply from 1950 to 2006. Here is a chart of the U.S. national debt for the same period. How interesting it is that the trends are virtually the same. For the more money there is, the more debt there is. The more debt there is, the more money there is. To put it a different way, every single dollar in your wallet is owed to somebody by somebody. For remember, the only way the money can come into existence is from loans. Therefore, if everyone in the country were able to pay off all debts, including the government, there would not be $1 in circulation.
It says, if there were no debts in our money system, there wouldn't be any money. So there you go. That's a good quote right there. If there was no debt in our money system, there wouldn't be any money. So put that in perspective.
In fact, the last time in American history the national debt was completely paid off was in 1835, after President Andrew Jackson shut down the central bank that preceded the Federal Reserve. In fact, Jackson's entire political platform essentially revolved around his commitment to shut down the central bank, stating at one point, "The bold efforts the present bank has made to control the government are but premonitions of the fate that awaits the American people, should they be deluded into a perpetuation of this institution or the establishment of another like it."
So that's a critical quote right there from Andrew Jackson back in 1767. Well, he lived from 1767 up to 1845. So they was fighting this fight back then. What y'all think happened in history where these central banks seized complete control over the United States and the world? You know what I'm saying? People fought back against these central banks, and a lot of times they won. And then sometimes, they eventually lost. And you know why? It was because of the people. The people was uninformed. The people, like right now in today's times, people are sheep. We like to call them sheep in 2025, or lost souls. people eventually got rocked to sleep and gave up their rights, gave up their freedoms for what, entertainment or whatever they had to offer them back during those times. A white picket fence, the American dream. So they sold Americans the American dream, and eventually we fell for the American dream. What, go to school, get a good education, go to college, get a big house, get a good paying job. And they funneled us right into the debt system, taking out a mortgage. You know, you'll never own that home. God forbid anything happens. And then at the same time, you thought you was making a good salary 10 years ago, but in today's time, that salary doesn't pay enough to keep up with the mortgage or the interest rates or the fluctuation in the fluctuation in interest rates. Hopefully you got a fixed interest rate, but most Americans don't even know about a fixed interest rate, and they go ahead and get that fluctuating interest rate, and they get caught up in that game. So, and then also on top of the insurances, and it's all one big game that at the end of the day, you might not be able to own nothing, and you're going to be happy about it. So that's already in place. Let's continue.
Unfortunately, his message was short-lived, and the international bankers succeeded to install another central bank in 1913, the Federal Reserve. And as long as this institution exists, perpetual debt is guaranteed. Now, so far we have discussed the reality that money is created out of debt through loans. These loans are based on a bank's reserves, and reserves are derived from deposits. And through this fractional reserve system, any one deposit can create 9 times its original value, in turn debasing the existing money supply, raising prices in society. And since all this money is created out of debt and circulated randomly through commerce, people become detached from their original debt, and a disequilibrium exists where people are forced to compete for labor in order to pool enough money out of the money supply to cover their costs of living.
Now let me run that back right quick. Let me run that back. How people are forced to compete for labor. This is a game. It's survival of the fittest out here. You know what I'm saying? Like, it been that way, but some people just go about their day not realizing it's really survival of the fittest every day. It's like Hunger Games or whatever you want to refer to. It's survival of the fittest, and let the best man or woman win out here in society. And it's a dog eat dog world. And also you're competing against corporations. So if you're a small business, small mom and pop, how can you compete with a Walmart? Can you produce oil? No, you can't. Can you, you know what I'm saying? It's a dog eat dog world. So let's go ahead and replay that.
Society. And since all this money is created out of debt and circulated randomly through commerce, people become detached from their original debt, and a disequilibrium exists where people are forced to compete for labor in order to pool enough money out of the money supply to cover their costs of living.
That's just mind-boggling to me, and that's why I say this is slavery 2.0, and you got the elites sitting on top of the mountain. They don't have to deal with this because they own true wealth, because they own like ranches and estates and countries and islands and shit. They don't have to deal with this. Like, imagine this game that's being played where the United States government, they're broke, so they need to ask for money. They got to request some type of money in the form of a loan. They get the money from the central bank. They deposit it into a bank account. They disperse it throughout the economy. And then everybody at the bottom got to fight for the scraps. So that's us trying to get hired at a job. We're at the mercy of a job because it's in the best interest of a corporation if they want to continue to hire you or fire you. At the end of the day, they're gonna their bottom line is more important than having a ton of employees that is taking up insurance. They're taking up, it's a cost to employers to have a lot of employees. That's why we see like a lot of corporations bringing on artificial intelligence. They're bringing in AI. They're bringing in robotics like Amazon and some other corporations. They're trying to replace employees because employees are too expensive. But we're left to fight for the scraps from the top down. And this is why I teach technical analysis, and this is why I want y'all to learn. Go sign up with the Patreon.
As dysfunctional and backwards as all of this might seem, there is still one thing we have omitted from this equation. And it is this element of the structure which reveals the truly fraudulent nature of the system itself: the application of interest.
So the system will be, it will be functioning. It'll be an effed up system, but the hidden secret, the hidden weapon behind these banks, the central banks, the application of interest rates, that's the secret weapon. And the interest rate alone can make people thrive in the economy or suffer in the economy just by raising and lowering interest rates. And when you think real deeply about it, you gotta really like deep dive and go within to understand why is it lowering and raising interest rates. Why is that so impactful on the economy? It literally comes down to people dying. If you really go deep about it, people will die if they raise the interest rates too high. But if they lower the interest rates too low, then inflation will overtake everything and people won't have enough because they printed too much money. So it's a rigged game. It's a fucked up game, I'm telling you.
When the government borrows money from the Fed, or when a person borrows money from a bank, it almost always has to be paid back with accrued interest. In other words, almost every single dollar that exists must be eventually returned to a bank with interest paid as well. But if all money is borrowed from the central bank and is expanded by commercial banks through loans, only what would be referred to as the principal is being created in the money supply. So then, where is the money to cover all of the interest that is charged? Nowhere. It doesn't exist. The ramifications of this are staggering for the amount of money owed back.
It doesn't exist. It's the matrix. It's the freaking matrix. The money doesn't exist. So we're stuck in this game, just being played. And that's why we want to invest in these cryptocurrencies. We want a way out. Well, you still going to have to endure some of the game, but you got to make enough money to make it more comfortable for you.
Back to the banks will always exceed the amount of money that is available in circulation. This is why inflation is a constant in the economy, for new money is always needed to help cover the perpetual deficit built into the system, caused by the need to pay the interest. What this also means is that mathematically, defaults and bankruptcy are literally built into the system, and there will always be poor pockets of society that get the short end of the stick. An analogy would be a game of musical chairs, for once the music stops, somebody is left out to dry. And that's the point. It invariably transfers true wealth from the individual to the banks. For if you are unable to pay for your mortgage, they will take your property. This is particularly enraging when you realize that not only is such a default inevitable due to the fractional reserve practice, but also because of the fact that the money that the bank loaned to you didn't even legally exist in the first place. In 1969, there was a Minnesota court case involving a man named Jerome Daly, who was challenging the foreclosure of his home by the bank which provided the loan to purchase it. His argument was that the mortgage contract required both parties, being he and the bank, each put up a legitimate form of property for the exchange. In legal language, this is called consideration. Mr. Daly explained that the money was, in fact, not the property of the bank, for it was created out of nothing as soon as the loan agreement was signed. Remember what modern money mechanics stated about loans? What they do when they make loans is to accept promissory notes in exchange for credits. Reserves are unchanged by the loan transactions, but deposit credits constitute new additions to the total deposits of the banking system. In other words, the money doesn't come out of their existing assets. The bank is simply inventing it, putting up nothing of its own except for a theoretical liability on paper. As the court case progressed, the bank's president, Mr. Morgan, took the stand, and in the judge's personal memorandum, he recalled that The plaintiff, thanks President, admitted that, in combination with the Federal Reserve Bank, did create the money and credit upon its books by bookkeeping entry. The money and credit first came into existence when they created it. Mr. Morgan admitted that no United States law or statute existed which gave him the right to do this. A lawful consideration must exist and be tendered to support the note. The jury found that there was no lawful consideration, and I agree. He also poetically added, "Only God can create something of value out of nothing." And upon this revelation, the court rejected the bank's claim for foreclosure, and Daley kept his home. The implications of this court decision are immense. For every time you borrow money from a bank, whether it is a mortgage loan or a credit card charge, the money given to you is not only counterfeit, it is an illegitimate form of consideration, and hence voids the contract to repay, for the bank never had the money as property to begin with. Unfortunately, such legal realizations are suppressed and ignored, and the game of perpetual wealth transfer and perpetual debt continues.
Can y'all hear me? Can y'all hear me? Damn. Damn. Damn.